The stock market's gotten rather expensive, and the prospects of finding companies that are discounted, that are really good deals with regard to their stock price and overall future, has gotten harder. But finding companies that are overpriced is a lot easier. And I wanted to point out four companies that I think are grossly overpriced. They are overpriced by a big margin. And I wanted to point that out. In some cases, some of these stocks I would consider shorting, and I'll let you know which ones I'm probably going to establish a short position on, and which are just interesting to look at, but maybe a little too dangerous to put into a short position. Now, overall, even investors like Warren Buffett really find companies that are highly overpriced, and he doesn't short stocks. He just doesn't have the scale, as he said, to really pull something like that off. And if you could imagine, a great investor like him shorting a stock would probably really hurt that company. But me, I'm just an individual investor, and the companies aren't even going to notice if I do it. So it'll be interesting to try it on a few of these stocks that I think are grossly overpriced. So let me start off with the first stock that I think is grossly overpriced. The first stock that I think is grossly overpriced is Tesla. This company has seen its stock really rise a couple years ago, and investors were really excited. It became a magnificent seven stock because it really rose to a very high valuation. But since then, the company's really hit, or I should say, the stock of the company's really hit a skid. It's down more than 43% from its high. Overall, I think investors are mixed. Some people believe it's a car company, and if you're in that camp, this is grossly overpriced. Other investors believe it's a tech company, and they believe that it has a promising future. So I'm more of the camp that they're an auto company and they're beginning to behave that way. I'd like to point a few things out with regards to the revenue, their cost, their profitability, which is going to be a big anchor on their overall value. I think it's going to limit them. The volume of cars they try to sell and the competition they're seeing around the world. For example, China is coming out with a EV that's really good, and they're going to compete against Tesla around the world. So Tesla is going to find it very hard to continue to grow. At this point, they're not growing very much at all. Let's take a closer look. Over the last trailing 12 months, the company has only grown 1%, not a high growth stock like a lot of people believe it is. It once was a high growth stock. A couple of years ago, it was growing very fast. That's great. But you can see the competition is really getting to Tesla, and it's not going to change. It's just going to get harder and harder to sell their cars in a marketplace that has a lot of competitors that have a very good product in the form of EVs. Some people may say, well, this stock is really transformational. It's a $735 billion market cap. One big concern I have with this particular stock and company is their CEO is a rock star, but they have to share him with two other big companies, SpaceX and X, which was once Twitter. And it seems like Twitter really takes a lot of his mind share. Can he really pull that off? No other CEO for any big company really shares his time across three different companies. I think that is, if anything, confusing, and Elon's probably distracted at any one time. How could Tesla continue to operate and compete against other auto companies that really are focused on making the best cars for their customers? Their PE is really high, 64. This company is not growing. Big problem. Future PE, 82. Again, not growing. Analysts believe it's overpriced. Now, I believe it's overpriced by a very, very big margin, which I'll show later. With regards to their cash flow has declined. The company is in the auto industry, and they have had to put more capital back into their factories. They only produced $1.7 billion of free cash in the trailing 12 months. That's tiny compared to the market cap. That's somewhere in the neighborhood of 1% of free cash flow yield on that market cap. So that metric looks terrible for Tesla. I value companies based on their free cash flows as well as their earnings per share and establish a net present value, the cash flows they're going to produce in the future, as well as the earnings per share. Collectively, I think that Tesla is overpriced by 83%. If you consider their cash flows that they're operating with, which are very, very low, and then you look at their earnings per share, which is also based on their market cap, very low. I just don't quite understand how investors have been invested so much in Tesla and believe so much in the company. It is a car company. Maybe they're twice as good as GM, so maybe they deserve twice the market cap of GM. That would put them basically at the valuation that I'm putting forward here. So overall, Tesla is really overpriced. Now, is it a stock that I would short? The answer is no. I think with Tesla, there's just too many fans of the company. Each time that Elon pumps up the stock rallies for no apparent reason. There's no fundamental driven reason, but he's a rock star. And for the time being, it's a stock that could really go up 20, 30% just when Elon puts out a pretty big speech or drops some type of hint that the business is going to do something really special. Remember, he could say whatever he wants, but if you follow the execution of the company, they're falling behind on various marketplaces. And I think it's a stock that's really going to disappoint shareholders in the future. Palantir is a stock that's really overpriced. It's a company that has an exciting product, but when you get down to their fundamentals and study their revenue growth, they're not growing very fast and they're not very big. So it's surprising that investors are so excited about this stock. I would understand if they were growing at 100%, but as I'll show you later, the growth isn't quite amazing. It's almost average to their industry, yet their valuation is well above their fundamentals. Let's take a closer look. Palantir has a market cap of $79 billion. And I put alongside it two other software companies for comparison. Microsoft is the biggest company that is a software company at over 3 trillion. And then Adobe, a well-known software company, is at 238 billion. The revenue of Palantir is just 248 billion, while Microsoft's over 245 billion and Adobe is about 21 billion if you look at the trailing 12 months. When we get to PE, that's where you really see a stark difference. You have a PE ratio of 210 on Palantir. That's really high. The PE on Microsoft's only 36, and the PE on Adobe is 45. We go forward PE, the Palantir PE drops to 89, but again, Microsoft is a third of that PE. And this is a really well-known company. And Adobe looks really attractive at 27. Again, another well-known company. Now you might say to yourself, well, they're just growing much faster. And the answer to that question is not really. If you look at the growth of Palantir, they're growing at 21% if you look at the trailing 12 months, and they're just a $2.4 billion company revenue wise. Adobe is growing at 11%, and they are a $21 billion revenue company. So that growth rate really adds up to more than $2 billion of additional revenue they're putting on that income statement, whereas Palantir is only putting close to 500 million. So Palantir is overpriced if you look at the revenue growth compared to Adobe. Adobe is growing much uh, larger from a dollar perspective, yet their PE is much lower. Microsoft is also growing quite well, 15.67%, not too far from where Palantir is at. But you can get Microsoft's PE at one third the PE of Palantir. If you look at some smaller software companies like Zoom, they have $44.5 billion in revenue. They're growing slightly, much lower. But if you look at their valuation, it's much lower than Palantir. You can get Zoom almost at a very good discount, as well as DocuSign. DocuSign is growing almost 8%. It is larger than Palantir, and you can get DocuSign at a really good discount. So in the realm of software companies, I think Palantir is just really overpriced, and investors have really good choices for software investments that I think have better fundamentals than Palantir. Palantir is being sold at a premium of 66% if I value the net present value of their future cash flows as well as their earnings per share. That's a really big premium. And if you look at the market, you can buy Zoom and they're discounted at 71% because they generate more free cash flow. They're growing that cash flow just as well as Palantir. They have an established business. They're also bigger. They have a bigger enterprise value. So again, within the software space, Palantir is not that special, yet they command a really expensive stock price. And that's why I think Palantir is a very grossly premiumed stock. It is overpriced by a big margin. And I am going to start a short position on Palantir. I think it's a good opportunity to get probably a 30% return in the next 6 months because I think we're going to see headwinds on stock prices in the month of September and October. And I'm willing to bet that Palantir stock is going to drop in value. The next stock that's grossly overpriced is TSM, Taiwan Semiconductor. I've known of this company for a long time. I was a multi-year investor in TSM. I tripled my money investing in TSM. I think it's a great business, but the stock price is not the company and the company is not the stock price. The whole AI hype has really created a big expectation that the data center is just going to expand quite fast. And as a result, TSM stock's really high. But when we look at TSM's revenue growth, it is not showing a hockey stick like growth. It's actually just showing okay growth. Trailing 12 months, it's up 9%. In 23, they were down. And that's right in the middle of the AI hype. Why weren't more semiconductors being produced? And I think there's more fluff in that whole AI hype cycle than there is fact. And I believe that Taiwan Semiconductor is overpriced by a big margin. I believe TSM is overpriced by 55%. And you could tell that the stock's been appreciating, but their revenue hasn't really been growing. Their free cash flows haven't been growing. So when I value the company based on free cash flows that I expect, as well as earnings per share, it shows a big premium of 55%. Now, this would be a good candidate to short, but I'm already shorting two other semiconductor stocks. And I think having a third might be a little too much exposure. So I'm going to hold tight, but maybe begin to short them if things change a bit. And the fourth and final stock is NRG. NRG is a independent energy producer, and the AI hype has made the expectation that power producers are going to make lots of money. And I wanted to begin with the revenue for this company is actually down in the trailing 12 months. So if revenues are down, yet this stock price is really up, what gives? Why aren't they both consistently going in the same direction? The hype is going up, and so is revenue. At least show me some revenue growth. So that's why I think NRG is really sold at a premium, grossly overpriced. When I look at free cash flows and earnings per share for NRG, they are priced at a premium of 45%. And this is a utility. They grow very slow, but in this case here, they've actually been contracting the revenue. So that's just amazing. This stock's been pumped up so much if the revenues are actually declining. Now, would I short NRG? Not at this moment. I'd like to give it some more time and consider it in the future. But I just wanted to point out how overpriced this stock is. Those are the four companies that I think are really overpriced. Now, keep in mind that I truly believe that stock prices are not representative of companies. Companies tend to be really good entities that create products and services that provide something to a company or a consumer that gets value out of it. So the stock is not the company and the company is not the stock price. And I'm not saying anything bad about those companies. I'm just thinking these stock prices are just too high. And they present an opportunity for an investor like myself to take advantage of the exuberance that's been exhibited in these stocks. I hope you found it interesting. And keep in mind, I'm just an individual investor sharing my experience, my thoughts, and my opinions. I do not recommend you short any of the companies that I just talked about. I don't recommend you buy, hold, or sell any of the companies I just talked about. Please weigh your decisions really carefully with regards to your investments. Good luck investing in 2024.